Often, a property available for sale is held by the seller owner as an investment or for use in their business. Investment property includes income property and vacant land held for profit. Business property is property used in the owner's trade or business and held for over 1 year. Tax-wise, investment and business property are classified as like-kind, 1031 property for purposes of avoiding California and federal income tax reporting of profit on its sale. This is all covered in the Internal Revenue Code section 1031. Property used as a seller's principal residence is not like-kind 1031 property. Likewise, property the owner intends to hold for less than 1 year and resell in the ongoing entrepreneurial activity is dealer property, such as a sale of lots created by developer. Dealer property is also not like-kind 1031 property. A 1031 exchange allows an owner to sell business use or investment real estate and use the sale proceeds to purchase replacement like-kind property without a tax on the profit taken on the property sold. The reinvestment transfers the cost basis, which is the original cost incurred to purchase and improve the property, less deductions for depreciation and destruction, remaining in the property sold to the replacement property purchased. Thus, when the net sales price of the sale of the 1031 property is greater than the owner's remaining cost basis in the property, the seller takes a profit on the sale, which is not reported and not taxed in a fully qualified 1031 transaction. But how does this relate to broker representation and fees? Let's take a look. A seller broker alert to an opportunity to provide additional fee-generating services, coupled with the sale of investment or business property, discusses a 1031 reinvestment plan with their client. The seller broker reviews with the seller client the process of locating suitable property to acquire for reinvestment, closing on the sale of the seller's 1031 property, proper transfer of net sales proceeds, and the closing of purchase of the 1031 reinvestment property within 1031 time periods. And again, critically, on replacement of the like-kind property, the seller owner avoids reporting profits and paying income taxes on the profit taken on the sale. You'll notice that, unique to a 1031 transaction, the owner essentially takes on two roles: that of the seller of the 1031 property sold and the buyer of the replacement 1031 property purchased. As in any employment of a broker by a buyer-client, the broker's right to locate replacement property and earn a fee mandates the broker negotiates and enters into a written buyer representation agreement with the client, as covered in a separate series. The written agreement to employ the broker is needed to both enforce collection of a fee and comply with DRE licensing law. An exclusive seller representation agreement achieves compliance with licensing law through its replacement property fee provisions. However, different retainer period rules apply when representing buyer clients who are individuals, but not so for entities. The representation period for an individual buyer is inconsistent with the rule controlling retainer periods when representing individual sellers. No distinction exists for entities whether they are buyers or sellers. Thus, to best protect your fee when representing an individual client in exchange of properties, The prudent broker enters into two separate representation agreements. One is a seller representation agreement, employing the broker to sell or exchange the individual client property, RPI Form 102. The other is a buyer representation agreement, authorizing the broker to locate property to be acquired by the individual client as a 1031 reinvestment property, RPI Form 103.1. Again, in an exchange, the client takes on both the role of a seller and a buyer. Further commentary about the 1031 reinvestment plan is covered separately.